Welcome to the On the Rise podcast, where we talk about time freedom, passive investing through real estate, finance, and mindset. Let's dive in. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice. I am not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. All right, welcome back to the show, On the Rise podcast listeners. I've got another amazing guest with me today, as I do as always. I've got Michael Crow on the show. Welcome, Michael.
Glad to be here. Thanks for having me.
Absolutely. Looking forward to it today. So Michael serves as the CEO and CIO of MC Enterprises, which is a long-term oriented, family-owned, permanent capital holding company for acquiring and growing small to medium-sized businesses or small businesses in general. Before Michael and I hit the record button here, we had a great conversation related to my background, in franchising and kind of the different, connections that I made in that space. And I thought there's really no better person to have on the show that's, somebody on the front lines, of different brands and helping to grow, small business, enterprises, across the US. So Michael, would love for you to let us know a little bit more about, your background, your journey, what you're focused on today, et cetera.
Hey, happy to do it. So, Jeremy, I started as many of us did, following the corporate path. I got out of college and thought that was the way to go. I didn't come from entrepreneurial parents. We were kind of aspiring middle class, as we like to call it. So I put myself through school, got a job at a very large consulting firm, traveled the world doing that for a while, which was great experience. Ended up as CFO for one of the larger banks of the international operations, and ended up deputy vice chairman, and thought I was going to run the place at a young age, and found out I didn't have a job when they merged with another bank. So that was my introduction into corporate life, which is, if you don't own it, you don't control it, which has kind of been a philosophy that I've tried to keep from that point forward. And then since then, I've always been around real estate. I was actually doing real estate projects on the side while I was a senior vice president at the bank, and found out at the end of the year I made a lot more money doing real estate than I did actually in my position, which kind of influenced my risk taking to say, like, I should do more of this, less of that. And I've been, both in and out of real estate along the time, development, construction, both residential, and then over a period of about 20 years, I've done quite a bit in some large scale things with Lehman Brothers and others, and then back down on the ground with owning the actual assets. Most recently, built up a portfolio in the Southeast in apartments, decent size, and 5,000 plus units. And then when it peaked in 21, 22, I did a lot of buying in COVID, which we can talk about, because I do believe real estate's the best contrarian kind of play. And then started selling in 22, 23, and started buying companies again, including some franchises where, it gets back to my philosophy, which is you need to own assets, and whether it's pieces of them or the whole thing. And that's where you're going to get your wealth and your freedom from.
Yeah, no, I appreciate that breakdown. Oftentimes I talk about, kind of these two different investment strategies. You can either go to Wall Street or you can go to Main Street, or you can diversify between the two, right? So I oftentimes will tell investors that the prudent approach in Wall Street is diversification. The prudent approach in investing in Main Street is also diversification, right? And so on the Main Street side, you can either choose to be an active owner operator or you can choose to be a passive investor. And this is really true whether you're investing in Main Street franchise businesses or you're investing in, passive real estate syndications, right? So maybe can you kind of talk to, our listening audience a little bit more about, kind of this concept or prudent approach, to diversifying across different hard assets outside of Wall Street and into Main Street?
Yeah, happy to. I really like the way you phrase that too, Jeremy, where, it's you can own and operate it, and that is not passive by nature. And I've made that mistake before, thinking I had the right guy to run something. I owned it, kind of put it on remote control, and found out I had to step back in later. So I learned the hard way that you really don't cross those lines. If you're going to own something, you're going to own it. And if you're going to be passive and diversified, that's a great strategy. And I would argue that diversification can be taken a little bit too far at times, and that it is good to have a view on things and try to get with the right people, because a lot of our outcomes in investing come down from being in the right place at the right time with the right people. So, five great positions rather than 50 average ones, I would take all day long.
Yeah, it makes total sense to me. I know when it comes to Main Street, investing, and again, that could be, anything from franchising, active owner operator to on the passive side, real estate, et cetera. How important is it, in your opinion, Michael, that you're really investing in the right jockey and not necessarily as concerned about investing in the right horse?
Yeah, it's an interesting point in question that I struggle with a little bit, and here's why. Like I follow Warren Buffett, like many people, and Warren has a saying which I've always liked, which is try to buy a business that any fool can run, because eventually one will. So he buys businesses and with management in there, but he buys great businesses, which are really hard to find. And then, having been around the venture space and others as well, I can tell you that the right person, the right jockey, will pivot and make things happen and solve problems and get there in ways that you don't see. Uh, and so, obviously the goal is to have both. It's not always possible. So I kind of lean to now, if it's passive for me in an investment, I make sure that I'm comfortable with the space that it's going into, and then I just try to find the best jockey or person or sponsor in that to kind of back. And I think that's something that's holding up pretty well over time.
Yeah, that makes total sense. I know that, there's this concept out there of what they call the velocity of money, right? Keeping money moving throughout the system, money that sits stagnant, or stale tends to lose its value over time. How do you balance, this concept of the velocity of money, with, your kind of stance on this permanent, capital, being held in a permanent type of an investment vehicle. How does that permanent capital, really change the way that you underwrite, you operate, you grow businesses compared to, this traditional rinse and repeat velocity of money in private capital?
Yeah, velocity money, I think, was created by a bunch of Wall Street guys to get people to trade in and out of things and generate a lot of commissions. I don't, I don't think there's been any study that I've ever seen that said anybody's going to beat the market over a period of time. That timing things, getting in, getting out. There's lots of data to see this, but if in most S&P 500 years that are good years, there's still days where it dropped 7-8%, and if you got out and didn't catch the upswing back, you didn't get the return. So I do believe that the friction costs in the transactional side of trying to time things is wrong. I think you're better off to, particularly if you're passive, think about what you think will make sense, and try to find the best people and the best advisors around that, and go kind of all in, and then set it and forget it. So the permanent equity concept comes from understanding, if you look at the way that the bigger family offices and the groups that have got there and maintain it, they don't think about internal rate of return. What they think about is multiples on their capital and compounding it over time. So that's a different philosophy than a lot of real estate investors, for example. I used to not argue, but discuss with people saying, well, what's the IRR? And I said, well, if you'd like us to sell it in 6 months and get you a 30% IRR, we can probably do that. Or would you like to hold this for 5 years and get, 3 or 4x your money? Because they're different dynamics. And depending on the incentives for the sponsor or the type of investment, you should know what you're getting into. Is aligning those incentives with the sponsor is kind of critical.
Yeah, makes total sense. And I also know that this kind of concept of entrepreneurship, through acquisition, is really exploding in popularity. From your perspective, what's really driving this kind of surge in people's desire to scratch the entrepreneurial itch, through acquiring small businesses?
I think it's driven by a couple things, Jeremy. One is that the real estate syndication business really took off with the crowdfunding models and everything that went on, and that was back in an environment where rates were almost near zero. And so, the value added real estate model really worked well in that case. You could get in, do some work, flip it, turn around, rinse and repeat. When interest rates are, where they are today, and everyone's got a view. Mine has been they're not coming down, and so far I've been right on that. But where I think things are happening is people are saying, "Hey, why don't we start investing in, Main Street businesses, franchises, small businesses, whatever? And how do we do that?" And now there are ways to do that in a passive or fractional way, with some pretty well defined incentive structures that still give the sponsors a lot of upside, but protect the that. And then the basic difference is in the smaller acquisitions like we do, and that I'm still very involved in. We're paying 3 to 4, in most cases 5 times cash flow. I can't get a real estate investment that really even has positive leverage today. I mean, it's really hard. So, you're just paying a lot more for the same cash flow in real estate than you are in a business. If you run a business flat and you paid 4 times, with no debt, you'd be at 25% return on cash every year, right? It's just basic math. So I think that's what's driving it. People are saying, hey, maybe I'll put some money over here. And I think ultimately they got to talk to their advisors. Neither one of us is a financial advisor. I am a CPA in the old days, but um, I think you should be in both. I don't think you should ever leave real estate entirely. I don't, and I think people should have exposure to uh, Main Street businesses. And if you don't want to own them and take on the debt and all that, then invest with somebody who does. I think you'd be very happy. I mean, the search fund returns that are well established from Stanford and others that have published this data. It's out there if you Google it or AI it. It's near 30% compounded returns over 25-year history. Tough to beat.
Yeah, I couldn't agree with you more, and I appreciate you highlighting that, truth that you and I both know is out there. I'd like to maybe kind of pivot and talk about, kind of this consumer-driven, type small business, focus that you have, and I know that you've acquired, several home and property service companies. My father recently retired from the HVAC, industry. My teenage boys now run an outdoor services company, and my dad and my boys know, once you get into the house, right, there's all kinds of areas of opportunity to service, that residential homeowner outside of maybe the initial service that they needed to have completed. So what qualities make a small business truly durable and worth buying, versus maybe one that looks good on paper but won't necessarily scale?
Yeah, that's the challenge of that is it's hard to define, but you kind of know it when you see it, right? And I would say that the things that we're looking for in terms of scalability is, are you scaling by adding services in an adjacent, you know, like you're talking about home services. So if you're in there doing plumbing work, can you add HVAC to it? Can you add electrical to it? Can you do other things? Makes perfect sense. And then the other way people will scale is, oh, I'm really good at running an HVAC company. Let me take it into some other markets and run more HVAC companies. And it's usually one or the other. I've tried at times to do both at the same time, and I've probably gotten my nose punched a couple times along the way for trying. Uh, but I do think that that's uh, really understanding, who you're either investing in or who you are, and whether you want to stay local basically, or whether you're willing to travel and get into other markets. It's really kind of what it comes down to. It's almost a lifestyle choice too of where you want to travel or be, and you want to be home at 5 o'clock, and maybe if you own a business, if you're passive, you can go home at 5 o'clock and let someone else worry about it. But yeah, I think that hopefully I answered your question, but I do think there's a sense that when you want to scale something, what do you do that is competitive and adds value to the homeowner or your customer? And if you can rinse and repeat on that, you can be very successful.
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
I think about, kind of this, 9 to 5 versus the 5 to 9, right? And there's some folks that, are kind of mid-career, higher net worth individuals, maybe, climbing up the corporate ladder. They're considering, buying or investing into a business because they want to replace the dependence, on the W-2. Kind of doubling back on, the Jockey discussion we had before. What are the most important traits, in your opinion, that individual needs to evaluate in themselves before becoming a small business owner?
It reminds me of a conversation I had with a real estate billionaire that would invest with me in deals. And I won't use his name. He's a very well-known guy. And his due diligence was the following. It was, all right, Michael, tell me what the deal is. And then he'd should stop me at 3 minutes. And I'd have a whole pitch. He goes, okay, that's fine. Now I just need to know how much you're putting in. And I'm going to do 5X whatever you put in. So pick your number. He goes, you won't change my life no matter what you're doing. Just don't embarrass me. But I basically want to back you, but I'll back you in a relationship to how serious you are about this deal. So I have found that finding investments in people where they have their own capital at risk, they've signed an SBA loan, they've got real downside here, then it's not just optionality for them. That's when you're going to do your best investing. And that's what I think the number one thing I look for in someone is, what are their incentives? Are they going to be there at, on Saturday and Sunday if need be when something's wrong and they got to fix it? Or are they going to walk away and go look for another project and say, "Oh, too bad you lost your money"? And I don't want of those. I want the I want the guys who are got something to lose too.
Yeah, that makes total sense. I spent almost 25 years, selling SaaS-based software solutions to small business franchise owners. I sold to about 16,000 of them over the course of a 25, year career. And I can tell you there's a stark difference between, those that find success versus those that fail. And there's a lot of character, attributes and qualities, that differentiate the top performers from the weak performers. But one in particular that stands out is this, this concept of tenacity, right? Do you have tenacity or not? And whether or not that's an environmental thing, something that you were born with, something that you learned over time, I'm not sure. But I do know that there's a big difference between those that find success and those that don't. And it usually comes down to that one word, tenacity. Does that make sense and resonate?
It does entirely. There's that famous marshmallow test that the kids would take when they're whatever at age 2 or 3, and could a 3-year-old defer gratification for getting 2 marshmallows later versus eating one now? I'm not sure there's a better test for who to hire as in your place. I know in my own track record, I've made a lot of mistakes in hiring people, and the mistakes I usually made related to they looked really good on paper and interviewed really well, but they didn't have the tenacity. They had a different objective, which is a bigger base salary and compensation that reflected their stature, perhaps. But what I really would say, tenacity with effectiveness so that you could solve problems, because owning businesses, as opposed to passive investing perhaps, but owning a business, owning a real estate, um, I had 5,000 units around 4 states. I mean, it was problems every day. So we had to learn how to solve problems and stick it out. And that's what it comes down to. It's solving problems and then having the tenacity, as you say, to make sure that you're going to do whatever it takes to be successful.
Yeah, I love that you mentioned that, and it's this. There's a lot of people that are they avoid areas where there can be any level or layer of fear, right, or failure, right. They're almost afraid to make decisions, or they're afraid, to get out of the starting blocks, or they're afraid to crash through that next barrier because they're afraid of failure, right, and meeting failure on the other end of that, and that's what really gives people, in my opinion, a lot of paralysis by analysis, or analysis by paralysis, whatever you want to call it, right? It cripples a lot of people, right? And so I think, that also is a defining thing between, again, those that find success and those that don't, is those that do are not afraid to fail. Does that make sense?
Totally. Maybe a relevant example for people listening would be, how did everybody react in COVID? And, it was a tough time for a lot of folks. And I took the position that, look, the long-term trend is positive. They're taking rates to zero. People are panicking. This is a time to buy real estate, not to be selling. And I bought 2,000 and plus units in about a 9 month period of time. And I was fortunate to have investors, mostly institutional, some high net worth, that didn't even visit the property. They're just like, I trust you. If you think this is good, we're going to go in. And within 18 months, every one of those deals was 2 to 3x our equity return. It was just buying right, having probably the point I'm trying to make in saying that is there's never perfect information. So the paralysis by analysis concept, I think, is very appropriate, because if people think they can know every single thing about the investment, they're just wrong. you you just have to understand that you're going to fail, you're going to have little setbacks, and the key is to make them little and not big, right? So another time, fly planes like this thing here, and there was a thing in the piloting called the error chain. So what you wanted to do is you want to correct little mistakes quickly before they become compounding big mistakes. And so I find that's a useful metaphor for running a business, and that you want to understand you're going to fail every single day. You just want to fail quickly, inexpensively, and adjust. And if you can keep that mindset to it, I think you can be very successful in business and in investing. Not everything's going to work, but if it works in a way that didn't really hurt you, and, you thought you were going to get a 15% return on something, it came in at 10, but you didn't risk your capital, that could be considered a win. It's not necessarily failing. Failing is really only permanent when you give up and quit.
Yeah, that's right. I appreciate your insight there. This next kind of question, as we look to wrap up, totally, you can make this a commercial if you would like, in terms of what your answer is. I'm on board with that. But as we kind of look out into the future here, 5 to 10 years, in your opinion, where do you see the best, opportunities for entrepreneurs who want to build wealth through acquisition, rather than starting from scratch?
Yeah, my answer is, and I've actually got a soft plug for a book I'll be coming out with. It's almost finished, and it gets the central thesis is you need to own things. All right, you need to own assets. It's not enough to be working and trying to save. I don't think that really is working out for very many Americans, and if the statistics back that up. I think something around 20% of Americans are actually set for retirement. And it's really hard to get there if you're going to take that kind of approach. I think if you own real estate, if you own businesses, if you are more comfortable in one versus the other, then that's fine. I think 5 to 10 years from now, I think it will be very normal for people to say, I have a big piece of my portfolio in Main Street businesses spread over a few investments, just like they do in real estate now. It's you can have a conversation with somebody and they'll say, well, I own some industrial, I'm in this partnership, I'm in this deal. And I think that will be very commonplace to do the same conversation, and it'll come back with small business being part of that mix.
Yeah, well, I couldn't agree with you more here. For my listening audience that knows me personally, I think I'm now in 61, investments that are all cash flowing today. Each of these investments could be anything from multifamily to industrial, retail, flex office, franchise-owned businesses, as a passive, limited partner investor in those deals. And it's truly the way to build, wealth, right? Is by owning, hard assets, or at least owning a stake, in a cash flowing business, whether that's a franchise brand or, that's a real estate, syndication. That's where real wealth is built in America today.
I agree. I tell my kids the same thing. Like I've got a daughter that's a lawyer at the biggest firm in the world, and my son-in-law is a doctor. I said, that's great. And you're making a lot of, W-2 income. You really need to get over to the other side and figure out how to own some stuff along the way. And I think you're right on track as well with you and I are probably violent agreement here that you got to be able to own these things and be in a position where you're going to be part of that success, and 10 years from now these assets will be worth more than they are today. So do your best to defer some gratification and maybe invest a little bit more.
Yep, that makes total sense. Well, Michael, this has been a valuable conversation. I know for our listeners, what might be one or two different ways that we can connect with you to learn more about what you're up to offline?
Yeah, happy to do that. Happy to chat with people, particularly if they're interested in acquiring a small business or need some capital, whatever. I both invest in those and help, put those together for folks. That would be LinkedIn, easy to find there. Website, crowcompanies.com, lists some of the businesses I have, podcast I have there. And then, any other way that they can find me. I mean, I'm not that hard to get to, I think.
That sounds good. Well, we'll put that website link in the show notes as well as your LinkedIn handle. Again, Michael, really appreciate the value that you brought us today.
Wonderful. I enjoyed it. Thanks, Jeremy.
Yes, of course. And listening audience, thank you again for joining another episode of the On the Rise podcast. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the On the Rise podcast. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decisions, please consult with a professional. This show is copyrighted by the On the Rise podcast. Written permissions must be granted before syndication or rebroadcasting.